Hi, I'm Guy Myles, founder and CEO here at Flying Colours. In each of these videos, I talk about a specific theme and why it matters when it comes to investing your money. Today, we're going to be looking at how to use the information you can get from the value of an investment to try and improve long-term returns and better manage risk for our clients. As ever, if you enjoy this video, please do give it a like and a share. So here we go, finding value in investments. As a starting point, what is the valuation of an investment? Valuation is a time-tested measure that looks at the price of an investment relative to the profit it makes, the value of the assets it holds, or the income it generates. Different measures are used for different assets depending on what is most relevant. In general, the lower the price relative to its measure of value, the better the long-term expected returns should be. But it is, of course, a bit more complicated than this, and returns are not guaranteed. So let's take a look. The concept of value is easiest understood looking at the stock market, so I'm going to use that for my examples. There are a few ways to find value in stocks. Intrinsic valuation is pretty simple. It's looking at the underlying asset value of the company itself. Most companies will tend to trade at a premium to their net worth because investors anticipate further growth over time, but occasionally companies will be available at a discount. Relative valuation, well, this is an approach that compares a company's current and past value to that of its competitors or industry peers. A company that is priced lower than its peers may have a better chance of performing well over the long term. Have a look at the chart. Over the very long term, buying value stocks gives over 3.3% more in returns each year in the USA. For the rest of the developed world minus the USA, that figure stands at 5%. That's well worth having. In my experience, most investors, instead of looking at value, tend to look at recent performance as a guide to which investments will do best in the future. Doing this risks confusing past performance with being a robust future investment. Please remember, even the finest gems can lose their sparkle if they become overpriced. Take the Nifty 50, for example. This was a collection of 50 prominent companies in the US back in the 60s and 70s. They seemed untouchable and included big names like Procter & Gamble, Coca-Cola, and Disney. These companies suffered more than most when the first oil crisis hit. None of these companies had much to do with oil, but the change in the broader environment hit them hard. Take a look at this chart. You can clearly see how lackluster this group of companies became once they were deemed too expensive. The same is potentially true of today's Magnificent Seven stocks in the US. These stocks are some of the most valuable in the world. As most of you will know, these stocks have performed very well, but things can change and investors may not continue to do well. So, we've covered why looking for value is important, but we must remember that it is pointless buying something that is cheap if that investment will not do well and succeed over the long term. Long-term value is what really matters, and to help find this, we need to look at other things too. Investors need to keep in mind factors like quality and growth expectations as well as the broader economy. The conclusion I want you to draw from this is that valuations are important, assessing whether an investment is likely to work for you over the long term, but they aren't everything. In my experience, investments that offer good value give more protection when markets are choppy or inflation is on the rise. Patience, discipline, and a long-term perspective are crucial for successful investing. Thank you for watching. If you have any questions about today's video, please get in touch. Just email me at hello@fcadvice.co.uk. And finally, as ever, I've been talking about investing, which means that your capital is at risk.